The dollar machine is entering its final stage, and silver is signaling the shift. The uncomfortable truth, the one few policymakers or market commentators want to say out loud, is that what we are witnessing right now is not a random mix of inflation scares, currency volatility, or temporary commodity spikes. It is the predictable late phase of a monetary mechanism that has repeated across empires, reserve currencies, and financial systems for centuries. The U.S. dollar system, which still anchors global trade, debt, and financial markets, is entering the final mathematical stage of a cycle that always ends the same way. Currency stress, liquidity shortages, asset repricing, and a sudden rediscovery of real money, particularly gold and silver. Recent estimates suggest global debt now exceeds roughly $300 trillion when sovereign, corporate, and household obligations are combined. That number is not merely large, it is structurally unserviceable at normal interest rates, and that is the key point. This system only functions when borrowing costs stay artificially suppressed and liquidity constantly expands. The moment rates normalize, funding pressure emerges, debt rollovers become unstable, and markets begin searching for assets outside the credit system. The pattern is not ideological, it is arithmetic, and arithmetic always wins. The shocking part is not that markets are volatile or that inflation surged in recent years. The shocking part is that policymakers and investors still behave as if this episode is temporary, as if inflation can simply be engineered away, as if currencies can be debased without consequence, and as if debt can expand forever without triggering structural stress. History demonstrates otherwise with brutal consistency. Monetary systems follow a sequence. First, a stable foundation is built, usually after crisis. Confidence returns, trade expands, and credit grows. Next comes expansion, often justified by wars, social programs, or economic stabilization, and where governments increase spending and central banks gradually loosen discipline. Then arrives overextension, where debt grows faster than productive output and currency dilution begins to accelerate. Eventually comes crisis, when markets lose confidence in the system's ability to sustain itself. Funding markets tighten, currency volatility rises, and policymakers lose control. Finally, the inevitable outcome emerges, a reset either through inflation, currency restructuring, default, or some combination of all three. Real assets regain importance. Precious metals re-enter the conversation. And the cycle begins again. What matters now is that we are clearly deep into the latter phases of this mechanism. But to understand why silver is signaling a shift and why cheap silver may be ending, we must first see how this mechanism played out before. Because history does not repeat word for word, but the financial plumbing repeats almost perfectly. The first modern example sits squarely in the United States itself during the late Bretton Woods era leading into the 1970s. After World War II, the global monetary system was rebuilt around the dollar, with currencies pegged to it and the dollar convertible into gold at $35 per ounce. This arrangement provided stability and anchored global trade. That was the foundation stage: strong growth, expanding global commerce, and monetary discipline tied to gold reserves. But expansion pressures soon appeared. The U.S. financed both domestic social programs and the Vietnam War, spending far beyond tax revenues. Dollars flowed overseas through military bases and trade deficits. Foreign nations accumulated massive dollar reserves and began questioning whether the U.S. actually held enough gold to support convertibility. Credit growth expanded faster than productive capacity. Currency dilution began, even if not yet visible to ordinary citizens. By the late 1960s, crisis signals emerged. Foreign governments, notably France, began converting dollar reserves into gold. U.S. gold reserves drained steadily. Funding pressure grew. Confidence eroded. Policymakers faced a brutal choice: tighten policy and risk recession, or break the system's discipline. In 1971, President Nixon closed the gold window, ending dollar convertibility. That decision marked the loss of control phase. The dollar was no longer constrained by gold. Monetary expansion accelerated. The inevitable outcome followed swiftly. Inflation surged throughout the 1970s. Bond markets collapsed as yields rose. Purchasing power eroded, and precious metals exploded. Gold rose from $35 per ounce in the early 1970s to roughly $800 by 1980. Silver, more volatile and thinner in market structure, surged even more dramatically, briefly touching nearly $50 per ounce. This was not random speculation. It was the monetary system repricing itself after discipline broke. Investors fled paper assets into tangible stores of value. Importantly, the mechanics we now worry about, currency stress, bond market instability, inflation transmission, were all visible then. Oil price shocks amplified inflation. Wage pressures rose. Funding markets demanded higher yields to compensate for currency risk. The Federal Reserve eventually crushed inflation with extreme rate hikes under Paul Volcker, but only after immense financial pain. The lesson was clear. Once currency discipline breaks, restoring it is brutal and costly. Silver's behavior in that era matters because it reflected both monetary fear and supply dynamics. Industrial demand remained strong, but investment demand exploded as people sought alternatives to weakening currencies. Physical supply tightened, premiums rose, delivery demand surged. Paper promises increasingly collided with physical constraints. Sound familiar? But the mechanism did not end with the United States in the 1970s. It appeared again in different form during late 20th century currency crises across emerging markets, culminating in the Asian financial crisis of 1997-1998. The countries involved had built impressive growth stories through export expansion and foreign capital inflows. Their currencies were often pegged or tightly managed against the dollar, providing stability that encouraged borrowing. This was again the foundation stage: growth, confidence, foreign investment, and expanding credit. Then expansion accelerated. Governments and corporations borrowed heavily in dollars because rates were lower and capital was abundant. Domestic banks and companies accumulated dollar-denominated debt while earning revenues in local currencies. As long as currency pegs held, this structure appeared safe. Credit expanded rapidly. Asset prices boomed, property markets surged. Everything looked stable until it wasn't. The crisis stage began when capital flows reversed. Investors started doubting whether currency pegs were sustainable. Thailand's baht came under attack in 1997, forcing authorities to abandon the peg. Once the currency fell, dollar debts suddenly became much more expensive to repay. Panic spread across Asia. Indonesia, South Korea, and others faced collapsing currencies, banking crises, and economic contractions. Liquidity vanished. Funding markets froze. Confidence evaporated. The inevitable outcome again followed the pattern. Currencies collapsed, economies contracted sharply, and debt burdens exploded. International institutions intervened with rescue packages. But the reset still inflicted enormous damage. Asset prices plunged. Purchasing power declined. Citizens rushed into alternative stores of value where available. In several markets, gold demand surged as households sought protection from currency collapse. Once again, the mechanism proved mathematical. Excessive foreign borrowing, currency misalignment, and liquidity reversal led inevitably to crisis. What links these historical episodes is not geography or politics, but structure. Systems begin stable, expand through credit, lose discipline, encounter funding stress, and finally reset. Currency and debt imbalances cannot grow forever. Liquidity expansion cannot continue without consequences. Eventually, markets force adjustment. And now, we are seeing echoes of these dynamics on a global scale, not limited to one country or region. The modern dollar system is far larger and more interconnected than Bretton Woods ever was. Global trade, commodities pricing, and debt markets remain deeply tied to dollar funding. Yet expansion since the 2008 financial crisis, and especially since 2020, has been extraordinary. Central banks injected massive liquidity to stabilize economies. Government debt soared. Balance sheets expanded at historic speed. At first, it appeared manageable. Inflation stayed subdued for years. Bond yields remained low. Risk assets surged as liquidity flowed freely. But eventually, expansion turned into debasement pressure. Supply disruptions, fiscal stimulus, and tight labor markets pushed inflation higher across developed economies. Central banks responded with aggressive rate hikes. Suddenly, cheap funding vanished. This is where the mechanism begins tightening again. Higher yields increase government borrowing costs. Debt rollovers become more expensive. Bond auctions require stronger demand. Banks face funding pressure as depositors seek higher returns elsewhere. Currency volatility rises as capital flows shift in response to rate differentials. Emerging markets with dollar debt feel stress. Liquidity becomes scarcer. And when liquidity tightens, markets rediscover the difference between paper claims and real assets. We already see signs in precious metals markets. Despite strong dollar phases and rising yields, conditions that traditionally suppress metals prices, physical demand for gold and silver has remained resilient in many regions. Premiums above spot prices have widened periodically. Inventory drawdowns have appeared in key trading hubs. Delivery requests occasionally strain exchange inventories. Silver, in particular, reveals structural tension because its market is smaller and more industrially tied than gold. It is both monetary and industrial metal. Demand from solar panels, electronics, and electrification trends competes with investment demand during financial stress. When financial fear meets industrial consumption, supply becomes tight quickly. Paper contracts may show abundance, but physical markets tell another story. This divergence between paper pricing and physical availability is often an early warning. In past cycles, investors only noticed metals after currency or liquidity crises were already visible, but now signals are emerging earlier. Central banks globally have increased gold purchases in recent years, reflecting desire to diversify reserves away from pure dollar exposure. Households in inflation-sensitive regions continue accumulating metals as insurance. Industrial users compete for supply. All of this brings us to the uncomfortable bridging reality. The mechanism is once again approaching its decisive phase, but this time it involves the world's primary reserve currency and the deepest financial markets ever created. Bond yields, funding markets, and currency dynamics are aligning in ways that suggest systemic pressure is building beneath surface optimism. Silver's persistent resilience, despite conditions that should suppress it, may not be coincidence. It may be signal, because when liquidity contracts, debt burdens strain, and currency confidence weakens, markets begin repricing the foundations of money itself. And the question that must now be confronted is not whether this mechanism exists, but whether the current system is already entering the same final stage that history has shown again and again, only this time on a global scale that touches every asset, every currency, and every balance sheet in the world. And that is the reality we must now examine directly, step by step, in the present system itself. Why silver and gold become the last monetary escape valve. And to see where this mechanism leads next, we only need one more proof point, one final historical episode where policymakers believed they could indefinitely delay consequences, only to discover that liquidity, currency confidence, and debt mathematics eventually assert control over every system. The final case study sits in Europe in the decade leading into the sovereign debt crisis that exploded between 2010 and 2012. The euro itself, launched in 1999, began as a foundation story remarkably similar to previous cycles. The creation of a shared currency promised stability, lower transaction costs, and stronger trade integration. Countries like Greece, Spain, Italy, and Portugal suddenly gained access to borrowing costs previously reserved for Germany and other stronger economies. Investors treated Eurozone debt as nearly homogeneous. Risk premiums collapsed. Capital flowed freely. Growth appeared secure. Then expansion accelerated. Governments borrowed aggressively, private credit boomed, and housing markets in Spain and Ireland surged as cheap funding flooded the system. Banks accumulated sovereign bonds while sovereigns relied on banks for financing. Debt levels expanded far faster than productivity. Fiscal discipline weakened because markets no longer punished excess borrowing with higher yields. Confidence masked fragility. The crisis stage arrived when the global financial crisis of 2008 exposed structural weaknesses. As recession hit, government deficits ballooned, and investors began questioning whether weaker Eurozone nations could service debts without monetary sovereignty. Greece's fiscal reality became impossible to hide. Bond yields spiked. Funding markets withdrew. Sovereign spreads exploded. Banks holding government bonds suddenly faced solvency fears. Liquidity evaporated as capital fled perceived risk. The inevitable outcome followed brutally. Greece required multiple bailouts. Bondholders absorbed losses. Austerity measures crushed domestic demand. Spain and Italy faced funding scares. The European Central Bank ultimately intervened with Mario Draghi's 2012 pledge to do whatever it takes, effectively backstopping sovereign debt markets through bond purchases. Monetary expansion replaced discipline. The euro survived, but only through massive liquidity injection and implicit debt mutualization. The mechanism again proved universal. Stability created complacency. Expansion created overextension. Crisis removed market confidence. Liquidity intervention delayed collapse but did not erase underlying debt burdens. Gold demand surged across Europe during the panic as households sought safety outside fragile banking systems. The reset came through monetary intervention rather than immediate default, but the pattern remained intact. With three separate episodes, 1970s U.S. inflation, Asian currency collapses, and European sovereign crisis, the mechanism stands proven. Systems expand until debt and currency stability diverge. Liquidity stress exposes fragility. Real assets reprice. Monetary structures reset. Now the uncomfortable task is to apply the same mechanism directly to the present system, step by step, without illusions. The global dollar system remains the core of world finance. Commodities trade in dollars. Cross-border debt is largely dollar-denominated. Global banks depend on dollar funding markets. The U.S. Treasury market anchors risk-free pricing worldwide. For decades, this structure allowed enormous liquidity expansion because the world demanded dollars. But expansion since the 2008 crisis, and especially after pandemic-era stimulus, pushed the system into unprecedented territory. Federal debt surged. Central bank balance sheets exploded. Liquidity flooded markets. Check. Inflation eventually emerged not as a temporary anomaly, but as the logical consequence of monetary expansion colliding with supply constraints. Energy prices surged. Goods inflation accelerated. Wages climbed. Central banks responded with rapid rate hikes to restore credibility. Suddenly, free liquidity vanished. Financial conditions tightened globally. Dollar strength surged as higher U.S. yields attracted capital flows. Verified. Now, currency stress spreads internationally. Countries with large dollar debts must service obligations in a stronger dollar environment. Their domestic currencies weaken, making repayment harder. Central banks burn reserves, defending exchange rates, or raise rates to protect currencies, slowing domestic economies. Capital flows toward safety, draining liquidity from weaker regions. Emerging markets feel funding pressure first, but stress inevitably transmits back into developed markets through trade and banking channels. Undeniable. The next stage appears in debt rollovers. Governments and corporations worldwide issued enormous quantities of debt when rates were near zero. Those obligations now mature and must be refinanced at much higher yields. Debt servicing costs rise sharply. Budget deficits expand. Investors demand greater compensation for inflation and fiscal risk. Treasury auctions require stronger bid-to-cover ratios to maintain stability. When demand weakens, yields rise further. Check. Bond market plumbing reveals growing strain. Term premiums, which compensate investors for holding long-term bonds, have begun rising after years of suppression. Real yields, nominal yields minus inflation expectations, remain elevated relative to recent history, tightening financial conditions. Banks holding long-duration bonds suffer unrealized losses. Regional banking stress episodes demonstrate how quickly funding problems can surface when asset values fall. Verified. Funding markets themselves show fragility. The repo market, which provides short-term financing using treasury collateral, periodically requires central bank support to prevent rate spikes. Hedge funds employ basis trades, borrowing cheaply in repo markets to exploit small pricing differences between treasury futures and cash bonds. When volatility rises, these leveraged positions unwind, forcing bond sales that push yields higher, intensifying instability. Undeniable. Dollar funding stress also emerges through cross-currency basis swaps, where foreign institutions pay premiums to access dollars. When this basis widens, it signals scarcity of dollar liquidity abroad. Central banks sometimes reopen swap lines to provide emergency dollar funding, confirming strain beneath surface calm. Check. Liquidity squeezes propagate into risk assets. Equity markets, real estate, and speculative investments that thrived under cheap money struggle as discount rates rise. Volatility increases as investors reposition portfolios. Margin debt declines. Asset price corrections reduce household wealth, slowing consumption and growth. Economic momentum weakens, even as debt burdens remain high. And in this environment, markets again confront the difference between paper claims and physical assets. Precious metals begin acting as pressure valves. Despite rising yields, normally bearish for gold and silver, prices remain resilient because systemic risk hedging increases. Central bank gold purchases hit multi-decade highs in recent years, reflecting diversification away from pure dollar exposure. Retail demand for coins and bars periodically surges during stress episodes, undeniable. Silver's situation becomes particularly critical due to supply-demand mechanics. Industrial usage continues growing through solar energy expansion, electronics production, and electrification trends. Mine supply growth remains constrained by declining ore grades and investment limitations. Recycling supply cannot easily fill gaps. When investment demand rises simultaneously, physical inventories tighten quickly. Check. Exchange inventories periodically show drawdowns as delivery requests remove metal from registered supply categories. Premiums over spot prices widen in physical markets even when futures prices appear subdued. Paper markets can temporarily suppress price signals, but sustained delivery demand exposes supply limitations. This divergence has appeared before major price moves in previous cycles. Verified. The paper versus physical dynamic matters enormously. Futures markets allow large volumes of silver to trade without physical delivery, creating leverage that can disconnect prices from underlying supply-demand realities. But when enough participants demand actual metal, inventory stress emerges. Delivery queues lengthen, premiums rise, spot markets decouple from futures pricing. Physical constraints eventually overpower paper positioning. What this all signals is not an immediate collapse, but a transition. Liquidity is no longer freely expanding. Debt burdens are no longer easily serviced. Currency stability is increasingly questioned. Policymakers face impossible trade-offs: tighten to defend currencies and risk recession, or ease to support growth and risk inflation. Each choice carries consequences. Each accelerates parts of the mechanism already in motion. Silver and gold do not need hyperinflation to rise. They need declining confidence in financial assets as stable stores of value. And that decline often begins quietly with funding stresses, volatile auctions, rising term premiums, and subtle shifts in physical demand long before headlines acknowledge systemic change. Which brings us to the warning that must now be spoken clearly. This time is not different. Claims of American exceptionalism, arguments that technology alone will solve structural debt problems, and modern optimism that central banks can permanently manage cycles are comforting narratives. But comfort is not analysis. Debt mathematics does not disappear because innovation advances. Liquidity cycles do not vanish because markets become more digital. Monetary discipline cannot be ignored indefinitely without consequence. The practical takeaway is not panic. It is preparation and awareness. Watch bond auctions and bid to cover ratios. Monitor real yields and term premiums. Observe currency volatility and dollar funding stress indicators. Track central bank balance sheet trends. Watch precious metals premiums and exchange inventory changes. These signals reveal liquidity conditions before crises become obvious. And most importantly, avoid becoming the liquidity exit. The investor forced to sell assets into falling markets because positioning relied entirely on perpetual expansion. Build resilience. Understand risk exposure. Position with awareness that cycles turn, and liquidity can vanish faster than expected. In the next examination, we will go deeper into how this monetary machine was constructed and what the next structural shift may look like when pressures fully surface, because understanding the architecture is the difference between reacting in panic and acting with foresight when volatility arrives. The verdict, however, is already forming. Liquidity cycles are turning, debt burdens are tightening, real assets are quietly regaining importance. Silver's era of structural undervaluation may be ending not through speculation, but through the mathematics of monetary stress asserting itself once again. And as markets move toward the next decisive phase, one final question remains for anyone watching carefully. When confidence finally shifts, will you already understand what is happening? Or will you recognize it only after the reset has already begun?